Good morning. Welcome to Options Brew TV Traders Workshop, our Thursday edition, new time, 7:45 a.m. Central. Let's see what we have in store today. Look at Jason. Mark, I was telling you early pre-show. I met Jason in person for the first time in the at the OIC in Nashville. We had a hoot, right, Jason?
That's great. No, that sounded like a good conference.
It was fun. I met a lot of good people.
Yeah, it was good. It was well done. A lot of attendees. I thought great panels. Kind of fun. Really fun. Mark, we wish you were there.
You know, we've been doing this show for over a year, and the three of us have never been in the same room together.
Well, that means that we could be the same person. You realize that, right? There's a chance.
It's the same person doing all the voices.
That's right. That's right. What's new, guys? How's it been? Well, Jason, I know it's new to you. Mark, how have you been? You've been traveling around France or Europe?
Yeah, I have been. While you guys were in Nashville, I was down drinking wine in Bordeaux.
Oh, jeez, that sounds horrible.
Yeah, it was tough.
There's a lot of wine on the shelves behind you.
Yeah, that's been shipped off.
Uh-oh, are you getting ready to come home?
I have less than 10 bottles in this house. I think that's the lowest I've ever had.
Wow. Wow. So you're coming back, right?
I'm coming back. My wine's making the first trip.
Gotcha. Very good. What's been going on in the markets, guys? What are we seeing? Mark, I know you had something to chat about today.
It's been pretty ho-hum in the markets, I'd say. It feels like the last month or so has been, a welcome reprieve maybe from the prior 16, but it feels very calm out there. Yeah. Month vol spiders and SPX is like 12 or 13, right? It's calm sailing, smooth sailing out there.
Wow. Well, we do have this debt ceiling issue that's kind of lurking. I think that it's going to get solved, right, at the 11th hour, but that's a little bit of volatility potentially, right?
Well, if you think it will get solved and at the 11th hour, you should go sell some expensive puts would be my not financial advice for you.
That's right. Sell them expensive. And that's a great segue into selling expensive puts, right? Because you had something about puts today you wanted to chat about.
That was it.
Oh,
now, with some caveats, of course, but, selling a cash secured put, covered calls aren't the only way to collect premium. And, to the extent that you're bullish, right, a nice cash secured put, whether it's the start of a wheel trade, whether it's, just a income generation trade that you close, like, I think, especially given some of the skew behavior recently, there have been some interesting opportunities out there in that space.
Okay. Yeah, I agree with all that, by the way. And if that's your investment strategy, I think it's a great one, right? Let's use option premium, especially when it's high, skew is steep, to take advantage of it. I love that. Yep.
Yeah, well, like Mark has been saying, realized volatility has been down quite a bit. I mean, it was in single digits not long ago before the recent, couple, 20, 30 point moves. But even intraday realized volatility has been super low. And implied volatility has been still in like that 16 to 20 range. So it's been a lot of puts have been expensive. So this is the time to sell that premium. I've been selling premium now for like a couple months now. It's like cruising on the lazy river and
I was thinking about this yesterday. Speaking of selling premium, I went on my way back from the SIBO 50th anniversary. Right. So this year is the SIBO's 50th and the OCC's 50th. So congrats to them. Great event down in Chicago last night that I went to. Saw a lot of old friends from the floor. But on the way back, I was thinking about selling premium. After going to a SIBO event, I've been selling premium. You said for a few months now. I've been selling premium for 35 years. 35 years I've been selling premium. Now, Mark, you're a little different, though, from your past life. You guys probably were more of a premium buying sort of entity at large. I know you sold it when you could or you had to. But
yeah, I think back like as an aggregate firm position, I'd say 9 or 9.5 days out of 10, we were long.
Yeah.
Maybe 99 days out of 100. It was most of the time. Like, it was a rare exception. There were some occasions in 2008 where you flipped short, but like truly the rare exception that we were net short as a firm.
Yeah. Yeah. So I'd say as a firm, we were probably about neutral, but with a slight bias to selling it, slight. But I tended to be a little bit more of a seller than a buyer, but, very strategic in terms of units. I learned my lesson the hard way with units.
Oh yeah.
All that means is
I go back and forth.
Yeah, but you know what? It's hard to be short net units in today's world, especially if you're a retail trader, right? You've got to have an awful lot of money, and be a little crazy too. It's probably, you can do butterflies, you can do condors now, or you could always do them, but people didn't do them as much.
You can take on plenty of risk with a spread,
Yeah,
right?
absolutely.
There's
Absolutely.
no reason you need to get naked to do it.
Yeah, well, listen, getting naked is a different story, just so we're clear. Okay, back
Well,
to
the screen share. I actually have a good chart about
okay.
the difference between implied and realized.
Right. So let me say one thing before you get into this. And I want you to think about this. You don't have to answer right now. So a really good friend of both of ours, all of ours, said when a realized volatility is very low, implied's not low enough. Conversely, when realized volatility is very high, implied's not high enough. I think I agree with this person on that one. When you see really low realized 12, 10, implied's always much higher. It's still low on the scale, but it's always much higher. And is it a sale or not? I'm not sure. So anyway, just plant that seed. Think about it, or respond
It's
to
going
it.
to hang out at those lows for a lot longer than it's going to hang out at those highs.
Yeah, I agree with that. Okay, Mark. Sorry. What do we got here?
So what we're looking at really, is the difference between implied and realized. And so VRP, volatility risk premium, can be defined in a lot of different ways. But I sort of simplify it here by taking the difference between the realized historical vol over the past 30 days or 22 trading days and compare that to what implied vol was 30 days ago. So a month ago, what did we think the next 30 days were going to be like, and what did they actually turn out to be like?
Oh, okay.
Mm-hmm.
That sounds cool. Explain the lines here.
And so the two lines are at the money. The bolder green line is the at the money implied vol. The lighter green line is the close to close historical vol.
Okay.
And then the orange is that lag difference I was talking about. So implied minus realized. So we can see like the last month, like the month of April, this is spiders that we're looking at here. The VRP has been significant, right? So over the last month, we've been realizing a lot lower vol than the options have been predicting out 30 days.
Okay, so how is that indicated on the graph? I just want to make sure I understand. Sorry. So
that's the orange. The height of the orange bar is the difference between implieds versus actuals.
Okay, got it. Implied versus actual. Okay, so implied's much higher than actual because those green bars are so high. Is that right?
Because the orange bars are so high.
That's what I meant to say.
So the lines are the actual implied
Yep.
balls and historical balls, and the orange is the difference between those.
Okay, got it.
But it's lagged because you don't want the forward-looking vol for the next 30 days and the past 22 days of historical. You want what vol was 30 days ago and what it's done over those 30 days.
Okay, cool. And then, so how do we use this? How are you using this? Or, and this is not investment advice, just to be clear.
Of course not. But it's a good indication of when you want to be getting long or short options. To the extent that VRP is negative, that would mean buying options is a good do. To the extent that VRP is positive, that means selling options would be a good do. Now, all kinds of caveats about where in the curve you're doing it, at what tenor, of course. But this is just a sort of standard 30-day, look at that perspective. So, in the first part of the year, we're only seeing positive VRP and call it like the little over 2% range, but it's been up in the like 4, 5, 6, 7, 8% range over the difference of those two numbers over the last month. Mm-hmm. So to me, that says there's some tactical spreads to be getting short here.
Okay, getting short premium.
Getting short premium, correct.
Okay. Got it. Okay, cool. Just so we're clear too, even though implied is lower on the scale of implied volatility in terms of the range of where it has been or can be, it's still showing that it's a better sale now with a lower implied volatility, and you're measuring it relative to what's happening in the realized world, right?
Yep, and in most cases, VRP tends to be slightly positive.
Sure.
That, like, for the most part, the bias is positive. But of course, with any options position, what strike you pick, what tenor you pick, like that's all going to have a much. This doesn't mean just sell everything on the board, right? Like there are going to be realized spots where it doesn't work, even if it's consistently positive.
All right. So using this data, what give us an example of a spread or a trade that you like to do when you see these numbers the way they're playing out here?
Yeah, so this would actually normally be like my second step. But what I normally use to kind of find things that are looking expensive is, as the name suggests, the expensive put report.
No, that's clever. Just so we're clear. That's clever. The expensive put report. I love it.
Market makers are absolutely known for their naming prowess.
Oh my God. I love it. Expensive
Charm and Dana too, right?
That's right. There's no
that's got even more spice than this.
There's no question what expensive put report means. So it's perfect.
So this looks for the puts on the board that are the highest percent of their stock price. And I have a bunch of like delta and tenor ranges. So this is looking at, as of yesterday's close, what is cheap on the board what is expensive on the board relative to the current stock price. Beyond is at the top there. They had earnings after the bell yesterday. But it would have actually turned out to be a good sale. I think stock's only down like 2% or something like that.
Okay.
So
Robinhood had earnings. This is a good way to find out what company has earnings.
Yes. And that's sort of what you have to look at here, right? Is that like this is only step one of checking out what's going on. That it's like, find me something interesting and then let me figure out what the story is, and then I can go put on a trade about it. So I like to find an expensive put. I like to look at what VRP is doing, check if there's earnings. Beyond just also announced a secondary. So, there's some corporate action potential mixed in there, although it's an at the market secondary. But still, you want to figure out what the story is rather than just, like I said, whack everything on the board.
Yeah, well, at least it gets you to the right spot quickly, right?
Mm-hmm.
Pac West, I don't know if I'm going to sell those puts either.
Which one?
But a beyond put that's trading at like an implied vol in the hundreds, like compared to realized vol that's quite low. Like actually historical vol on that the last couple of weeks has been flat. Yeah. So even if it does have earnings, right? Like that, I think you could talk yourself into a sale there.
Yeah. Now, do you filter for put actual price? Like I'm looking at some nickels and 6 centers down there. Do you filter for the real baby? I obviously didn't hear, but can you filter for the real babies? Like I'm not sure I want to sell a 6 cent put. I can see the floor from 6 cents.
For sure. So I have a filter by dollar price. So these are all stocks under $15. Then I have like a 15 to 30 range. So the nice thing about selling those babies is that you can do a bunch of them, right? Like it's nice to have a diversified basket of these things. Yep. So, $10 stock means you only need $1,000 to sell an at the money cash secured put. So if you're trading with 10 grand, you could either do one in $100 stock, or you could do 10 different ones in a $10 stock. So sometimes there are advantages to doing the smaller ones, but if you want more meat on your bones, we'll go up in dollar price for you, Lex.
Okay. I like up in dollar price. I like big meat. Can you either one just define a cash secured put for the gang, so we know what that means? I don't want to assume that that's an obvious trade. So what does it mean? Either one, want to take a stab at that?
Yeah, it's a cash secured put is also cleverly named. It is a put that you are selling where the full price of the strike is the margin required. So if you're selling a $5 put on TTD or whatever, I guess that's $65, but whatever. You have to pay. You have $500 because it's 100 shares of cash that you need in order to secure the sale of that put.
So you pay for the full price down to zero of
Well,
the
yeah,
stock for the put.
That's how much margin is required in order for you to sell that put naked,
Okay.
minus the premium.
Okay, got it. So essentially what the clearing firm or the brokerage is doing is saying, hey, we're gonna let you sell this put, but if it goes to zero, we have no risk.
That's right.
Is that right?
Yes.
You better have all the cash in your account to buy that stock when you get assigned on it.
So is that automatic in the retail world? I should be asking myself this question, but is that an automatic feature in the retail world, or is there like a button you push to say I want to do a cash secured put, or do they just make you naturally do that if you're selling puts?
If you sell a naked put, it's naturally done. You don't have to.
Oh, you don't have to even worry about it because in the market maker days we didn't have that. We just had portfolio margin and you just did it.
Yeah, if you're on Reg T margin, you can't sell a put unless you have the right options clearance and you have the amount of cash that's in your account.
Gotcha. Okay, so now I love the strategy even more, right? Because the risk, at least for the risk from my side on the brokerage side, is immediately eliminated. So now you have an intelligent way of finding high price puts, whether it's skew or volatility or whatever your metric is, and this is a good one. And look at, you were selling premium, which I already love because it decays, and you're probably doing this because you like this stock and you're bullish, right? Bottom line, and you don't care about owning the stock if you get assigned. Is that right?
Yeah, I think that's a good justification for this. A lot of people will use it as like the first leg of a wheel trade, right? Where you sell the puts until you get the stock. And then once you own the stock, you sell the calls.
Yep.
It's good for some of those like MLP like names. I like it in like a high dividend paying names, like relatively stable names. Like I think that's a great way to get into a trade at a price you like.
Yeah. And then you scatter these around based on your scan here, and then you do a basket of different ones that you find most attractive, right?
Exactly. I have on some of the ones that are a little bit more medium term, like if it's going to be the start of a wheel trade on some dividend names, I typically will look at like a longer tenor, more like a 30-day range. Whereas if it's much more like, a kind of VRP scalping or short-term whacking, really, like that's where I really like these afternoon or something, and you've got 48 hours to expiration practically. So that's where some of those premiums are the fattest, and it gives you a lot of sort of turnover, right? You can do 3, 4, 5 of these in a week, and you get 25 trades in a month.
Yeah, nice. I love it. Jason, any comments on this? It's hard for you to be quiet, I think.
It's not. Yeah, it's not as hard when I'm listening to Mark. He had very interesting feedback here. I personally tend to do verticals as opposed to cash secured puts, but absolutely, especially in the current market environment, I've been selling puts is a great strategy. I've been short gamma now for the past couple months. Before that, and the other one comment that I'd want to say is implied volatility tends to chase realized volatility. When realized,
I got to think about that.
Okay, go ahead.
Say those things, I got to think about it. I got to put it in my head. Implied volatility tends to chase realized. Okay, I got it. Go ahead.
Yeah. So when realized volatility goes low and implied volatility is high, implied volatility will eventually try to chase realized low. And it takes a little while. The larger the spread, the longer it takes for any kind of massive market movement to manifest. So, and that we've seen that. If you saw Mark's chart there, you saw realized volatility dipping below 10%, and that was back when implied volatility was at 19 and 20. So we're seeing implied volatility starting to chase realized a little bit.
Yeah,
and so it's good to sell puts into that. Personally, the strategies that I've been doing is I've been short gamma on the indexes, but finding like little stocks here and there to go short on long gamma to try to hedge the downside. There's a lot of Volland has shown a lot of positive Vanna underneath the market. So if there's an expanding implied volatility something happens, the market will drop.
Yeah.
So it's it's been kind of tenuous, and a lot of people have been worried, but all those puts bought back in the banking crisis are still out there, and they're still burning off premium.
Yeah, it's like a crackling sound. A
Yeah.
long crackling sound of premium. So what Jason just described is kind of what Mark, like, I think he did the dispersion trade. I think he said
exactly what I was gonna
selling
say.
indexes and buying all the individual equity components in terms of volatility, that is. Big popular trade in our day among the big trading firms, especially index-based ones, trading firms, where they would be just pounding premium in the indices, and they'd have all their traders in the equities buying long gamma and being long premium across the board. And the beauty of that trade is, if it sets up correctly, is you're always going to get an outlier move in one of your equities, right? In which case you could absolutely make money on both sides. You could have a big move in individual names, and then you could have nothing really in the index itself. So you're collecting on the premium in the index, and you get these little outlier moves that's paying for your equity portfolio, right? So it's kind of a neat strategy.
Yep. No, a huge fan of that. And I mean, you can do it, obviously you can do it at scale with all 500 names in the S&P 500, or you can sort of do the poor man's version where you find those, most mispriced ones, and you can get pretty good effect from that too, I think.
Right. And Mark, is that a scan that you have on your software there?
I don't have anything dispersion related, but I like that idea. And you've probably taken out my Saturday.
Oh no more wine drinking in the south.
I don't have anything more to drink. I guess I'll just do some arithmetic.
There you go.
Go join a protest or something.
Yeah, go get a protest. Hey, when I come over to France, am I going to be involved in the protests at all?
Not unless you want.
I don't want
to. He's old enough, right?
I'm old enough to be involved in the protests, but
right.
Oh, they don't discriminate by age. It's everyone. It's they start them young too. Even the students are out there.
I don't want to be involved in any unrest, civil unrest. I want to just enjoy my cup of coffee and my glass of wine at about noon.
That you can certainly do.
All right.
The other thing I was going to add to Jason's point about implied chasing realized, I think that's very interesting, and it definitely happens. But I would emphasize what you said about the sort of lagged effect. Mm-hmm. And what I would describe that as is the notion that sort of volatility has a memory. That like there definitely is an element of the reason it's implieds are staying a little bit firmer than historicals are dropping and indicating is that like there's the debt ceiling you mentioned at the beginning of this, Lex. There's a dozen different things we could be worried about where inflation goes or what the next round of corporate earnings are going to. There's still enough, and we're still close enough to the carnage of 2022 that that vol is keeping up a little bit of a bid, and even skew more specifically is too.
Yep. Interesting. Okay, that's great. I love it. We probably have to roll along here, gents. Any last parting comments, thoughts? I got to be honest. It's been a boring week in the market. It really has. I mean, even our volume. Our volume we measure obviously every day, and it's definitely under average for the week, except for yesterday. Yesterday was a pretty good day. And OCC volume
been doing like 33 million a day. Like the year-to-date average is closer to 39 or 40.
I think year-to-date is actually 40 something.
So it's over 40. It could be.
I'll look at it. I got it right here, real quick. Hold on, I'll let you know real quick.
Well, there was also the coronation this weekend, and London was closed on Monday.
Yeah,
and Tuesday, I guess everybody was still, blinded by the pageantry. So,
right. So here's what I got. 2023 year-to-date average is 44 million. 44.3.
Wow.
Yeah, it's been up there. So yesterday was almost a 48 million contract day. May of 23 average is 41.3-ish million. So the month of May has been averaging that.
Wow.
Yeah. So, look at that's huge. That's back into the 10 billion range for the year ish, right? So I think we did 2022. We did 10.38 billion contracts system wide. So,
Wow.
and you know what? They're touting this zero DTE thing again. Whether you love them or not, it has added interest for sure, without a doubt.
Yeah.
So, all right, gents. Well, good to see you.
Seeing you,
We'll see-
Lex.
Yeah, you too. We'll see you next week, right? I think.
Yep.
One of these
Yes.
weeks I'm traveling again, but I don't know when. No, I do know when. A couple weeks, maybe next week. Well, we'll do it from
Who
where.
knows where we'll see you from?
Yeah. I'll be in South Carolina next week, but we'll.
Yeah. Don't forget to get a present for your mom.
That's true. That's true. We will do that.
There's
All
your
right,
gift.
boys. Good to see you as always. Mark, looking forward to seeing you back in the hood. I talked to some friends of ours we're having dinner with. We'll wait for you to come back before we do it.
All right, just give it a couple months. T-minus like 2 months.
Gotcha. All right. Have a good week, rest of the week and weekend. Bye now.
Happy trading, boys.
Yeah.
Happy trading.